right? So from this point, what has changed? What are the key things that have changed in the market, and how have our expectations changed? So the key thing that has changed is obviously on the interest rate front, right? Now, this graph may look a little bit confusing, but I'll just explain how this graph works. This is basically the government securities rates on the government securities, right? The blue line shows what the rates are now for 3 months, 6 months, going up to the 20-year, 30-year bond. And the red line shows what these rates were about a month ago, right? For example, the red line, which shows a month ago rates, the 3-month was at about 14%, which has now fallen to 11% or so, right? So that's how we interpret this yield curve, right? So what has happened is a month ago, the short tenor, the 3 months, 6 months, 12 months was higher compared to the long-term rates, which is not a normal phenomenon. It happens mostly when it's in recessionary conditions, when there's monetary tightening to a certain extent. That's when you have that scenario. And like what we expected, that correction has now happened, and now you're seeing a more normalized curve, right? So normalized curve is the short-term rates are now lower compared to the long-term rates, right? And in a normal economic environment, particularly in an accommodative stance from the central bank, this is the kind of yield curve that you will most likely see, right? So the normalized curve will continue, where short-term rates are going to be lower, and the long-term rates, there might be a smaller premium compared to huge premiums on the long-end interest rates, right? So from an interest rate perspective, right, the tenor differences has kind of adjusted, but we feel that there could be one more policy rate, and that could cut, which could be fueled by the inflation, right? So even though during January we saw a spike in terms of inflation going up to about 6.4%, this was mainly driven by the VAT and actually the vegetable prices increasing because of the drought, the higher rainfall, right? So this is correcting now. So with weather conditions kind of adjusting now, you're seeing vegetable prices easing off again, right? The main thing in terms of VAT adjustments is fuel, electricity, and so on. Those are here to stay. But when you look at the market, a lot of the companies have not been able to increase prices, right? Which is why we feel that overall, when you see food prices starting adjusting down, inflation will revert to about 5 to 6% in terms of the range that we're looking for 2024, which is an okay level and within the central bank's range of 5 to 7%. So it's not a major concern going into 2024, right? So food will be a main adjustment, and obviously there's a base effect coming in from last year. So inflation is not going to be very high. And that is also driven by central bank not printing money like what they used to before, right? So the graph here shows the printing every quarter, how much of printing that the central bank was doing. And if you look at towards the latter part, in 2Q, 3Q, and 4Q, the central bank has actually reduced or paid back a lot of the bonds that they have actually bought, right? So the printing phenomenon has eased off. And also there is a target that the central bank is working towards in terms of reducing the amount of money printing available in the system, right? So IMF has given a target, and we are expected to reduce our money printing or printed money by another 200 billion going into by third quarter of 2024, right? So without money printing being there, a lot of the demand-driven inflation that we've seen in the past, the currency depreciation, the spiraling effect on inflation is not going to be there like before, right? So it's a good thing. So the government is running entirely on its tax collections and rolling over its maturities from the public, rather than using monetary financing or printing money to manage its expenses, which is a good improvement that we've seen from a central bank perspective over the last 3-4 quarters. And even though rates have come down, we feel that there might be one more policy rate cut that we can expect going in towards April to June. And why we say this is because even though rates have come down, the economy is still taking a breather. Economy is recovering, but it's not recovering to the extent that the central bank would want to see, right? And that is because of the tax impact that came in January. You've seen the recovery that we saw in the months of November and December kind of easing off, and a slow economic phase during the month of January, right? Which may kind of put some pressure when we come into the first quarter GDP numbers. And this may force the central bank to ease to a certain extent, not too much easing, but at least one more stimulus to start the economy or get the economy rolling again, right? So from a policy rate perspective, the underlying interest rates in the market, we feel that another 100 basis points reduction is very possible going into the second quarter of 2024, right? And what this will mean for interest rate is that there could be a further reduction, mainly on the shorter term treasury bill rates. We are already seeing banks and financial institutions cutting down their deposit rates. Particularly from last week, we saw all banks across the board cutting deposit rates by 1%. So all the renewals that you will see will start adjusting at a lower single rate if you are investing with the banks right now, right? From a growth perspective, like what I said, the growth is not phenomenal. It might be only about a 2.5% recovery, but at least the trend has reversed from a negative trajectory to now being a more positive trajectory going into 2024. And the reduction in terms of the economic activity or the slower economic growth is because of the hit that is coming from taxation and so on, which has slowed down consumption, and also because a lot of the capex projects that the government was doing has come to a halt, right? So these are reasons why the economy, which used to grow at 4-5%, will only hit at about 2-2.5%, right? And normally what you see in other countries who've gone through a restructuring phase is that actual recovery back to norm only happens like 2 years after the restructuring cycle, right? So typically 2025 is where you will see a better improvement or getting back to the 3-3.5 kind of growth rate, because the good news is that we have only one more tax adjustment that the government has to implement, which is the property taxes, property, wealth, and transfer taxes. After that, you're not going to see any tax increases because those are the only changes that IMF wants in terms of tax changes going into the next 5 years, which means that if there are no new taxes coming in 2025, you will see that people's income will increase and taxation will remain the same, which means that their purchasing power can increase going into next year. The good news is that the economy is recovering. We are seeing an improvement in activity, right? Even though it's not to the levels that we envisaged to be, the numbers, the key economic indicators are showing that things are moving back again, right? So your early indicators like electricity usage, cargo operations, tourism, all that is indicating that the economy is picking up, right? It just needs a little bit more stimulus to kind of activate the market towards the right direction.